Disclaimer, this is not financial advice. Always do your own due diligence before putting your money to work. With that out of the way, let's have some fun and enjoy the episode. What's going on, y'all? Welcome back to another episode of the Rich Off Gains podcast, episode 15. It's your boy CB checking back in with y'all. Sorry for the delay. So sorry for the delay, man. We have been on the road, traveling, doing a lot of work, and we were stuck in the airport for 24 hours. So we unfortunately were not able to get the video and the podcast out on Monday. So my apologies for that. Tuesday when we got back, we had a lot of catching up on work we had to do. So with that, we are now presenting this to you today on Wednesday. Now this video should be going up before 1 o'clock. So if this video is up before 1 o'clock, clap it up. But if it's not, I apologize once again. We're not gonna waste any time though. With that being said, let's get right to it. Let's get right into it, y'all. Most people fail because they lack the ability to be patient long enough to receive the reward. Today we're gonna talk about the power of delayed gratification. Delayed gratification is delaying something greater than where you're at right now and receiving a reward for something later on down the road after putting in time, effort, energy into something in the present. Okay, so for example, going to the gym. You go to the gym, you show up, you work out, you eat healthy, and you're doing all these different things. In result, you'll start to see weight loss over a certain period of time. Now that might take weeks, that might take months, that might take years. It just depends on the level of intensity and energy you're putting into the thing for you to see the result. As an entrepreneur, most entrepreneurs don't see success within their first 5 years of doing business. So it might take you over 5 years, maybe even longer, to see a really big reward. And throughout that time and that process, you're still having to show up and sacrifice, you're still having to show up and work, you're still having to invest money into the business, and you're still having to build. That is where most people in entrepreneurship draw the line. However, that is also where most people find the most success. Once they see the breakthrough and they get the reward, now they know how long it took them to get there. But here's the crazy thing. The amount of time it took you to get your first breakthrough won't compare to the amount of time it will take you to get your second breakthrough. Let me dig in on that. Hopefully you guys caught that. When you get your first breakthrough, let's say you're trying to make 100,000. Okay, cool. It might take you, like I said, typically more than 5 years to make any kind of dent into the market or of what it is that you're doing. So 5 years in, you don't hit 100,000. Another 5 years in, you finally hit 100,000. That 100,000 that you made in the first 10 years will probably take you less than 2 years, if not less, to make the same 100,000. Why is that? Because now you're working with more resources. You have more access and more resources that are at your disposal for you to utilize and increase what you've already made. So now the next 100,000 will take less than a year. And then from there, the 200,000 that you just made will take even lesser time to make another 200,000 because of the resources continuing to compile and grow. So delayed gratification helps you be more disciplined and be more patient with receiving rather than always wanting the instant reward and instant spontaneous, feeling of achievement. You have to feel like something is pulling your energy and pulling on your ability to withstand and achieve, because that's what growing pains are. Look at delayed gratification as another way of growing pains, because that's all it is. If you just sit back, relax, put in the work, and you see the results, you know that the results that you're seeing aren't bad, they're just not producing the results that you want, then as long as you stay the course, you should see the big rewards and the big returns over time. You just have to let those things build and compound and grow. So you're gonna have to have a little bit of growing pain, you're gonna have to have a little bit of patience, a little bit of discipline, and once you've built up enough patience, you will then be willing to withstand whatever's thrown at you to receive the big reward in delayed gratification. In conclusion, develop a wealth of patience, being rich in patience, being rich in the willingness to wait it out and wait for the desired thing to come to you, not trying to chase it, because the more you try to chase it, it'll continue to move further and further away from you, because then you'll start to make mistakes, then you'll start to move sloppy, then you'll do things that are not helping you stay on track to receiving the big reward due to your inability to be patient and your ability to be impatient and chasing and trying to reach out and risk everything to get to the big goal faster than later. So build a wealth of patience, and I promise you, you will get the reward in due time. Investing tip of the week. Understand your time frames. Understand what time frames to look at and what time frames not to look at. If you're a day trader, it's different from if you're a swing trader. If you're a swing trader, it's different from if you're an investor. You want to understand time frames and looking at charts at certain time frames, because that could be the reason why you're losing so much money in the market, simply due to your inability to understand how to look at time frames. So let's talk about it. So if you're a day trader, you should not be looking at anything more than a 4-hour chart on a time frame for a day-to-day basis when it comes to day trading. Because if you're looking at a daily chart and the market closes every day, how are you going to find and dictate where your opportunities are by using the daily or weekly charts? It doesn't make sense. However, if you're looking at a 1-minute time frame or even a 5-minute time frame, now you're seeing the in real time action of where this price is moving in real time. So you can use anywhere from 1 minute to 4 hours on day trading time frames for charting to get better ideas and analysis on where you think the market will go. For me personally, I like to use 1 minute to, I do a top down analysis from 4 hours to 1 minute. I keep my charts on the 1 minute and the 15 minute to see the gap between where the market's reached and where it can go back to for a retracement or for even a continuation. And that helps me get better quality trades because I take my entries on the 1 minute and I look at the targets on the 15 minute. Hopefully you guys caught that. I'm dropping gems today. I know I was late, but look, we dropping gems today. So you want to use a different time frame for different entries and exits. So for your entry, you want to look at the smallest time frame, but for your exit, you want to look at the largest time frame, because now you're creating a value in between the two time frames to create opportunity for yourself. You see what I'm saying? There's a term for it. I'm not entirely sure what the term is, but just know that it's a really, 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 really good strategy to use when day trading, even when swing trading and investing as well. So using a time frame for your entries and using the time frame for your exits is really good. For swing traders, you want to you can look at the hourly charts, you can look at the 4-hour charts, but you don't want to look at anything more than a weekly chart, in my opinion, for swing trades. You know, you can look at the daily chart, you can look at the 4-hour chart, the hourly chart on the weekly basis when you're looking at week to week on what that particular chart is doing for your swing. And then anytime you get to the weekly, in my opinion, you can use it, but it's not likely that you will. You can look at the daily, however, because the daily will give you better idea of how that particular chart is moving. So swing traders, hourly, 4-hour, daily, maybe the weekly. And then for investors, like leap investors or long-term holds, you want to look at daily, weekly, and monthly. Anytime you're looking for a very, very aggressive discount or even a good price to buy, you would look at that weekly, even monthly chart to see the price difference between where the all-time high is and where the recent prices are, you know, just to kind of get a good comparison, a good gauge of where this chart has gone. And then you can then anticipate how long it took that price to come down for you to then anticipate how long it'll take for the price to go up. I'm dropping gems. Catch that. You know what I'm saying? So using the monthly chart for someone that's investing long-term, like a year to 2 years to even 5 or 10, gives you more edge on your investments compared to trading a 5-minute chart. A 5-minute chart is not going to do you justice because you're trying to find something that you're going to hold for a longer period of time compared to somebody who's holding on a 5-minute to 15-minute basis. So you want to be mindful of your time frames that you're using when trading and when you're investing, because it's very, very, very pivotal to help you get better exits and entries on your positions. So hopefully that helps you guys navigate the market a little bit better using your time frames. And this kind of gives you a good idea of how to use the time frames and when to use them, because everything's about perspective in the market. When you're using a hourly chart and you're trying to hold for a long period of time, you can do that. It just wouldn't make sense to, you know what I mean? Because you're holding for months on end, days, like you're not holding for a few days, you're holding for a few months, maybe even years, and you're looking at hourly charts. It just doesn't really correlate to the overall theme of how long you're holding that perspective. Does that make sense? Compared to somebody who's swing trading, yes, you would use an hourly chart because you can indicate how close it is to the target price that you're looking to get at or get out of. You know, you can be more pinpoint on your prices when you're using the hourly charts for swing trades. So yeah, that's what I got for you guys on the day trading tip of the week, or the investment tip of the week. Hopefully you guys enjoyed that. Make sure to leave a comment and let me know your thoughts on using time frames and how you navigate using time frames, because you can even go as low as like 1 second. You can look at charts from a 1 second level, and that's very, very, very micro in the grand scheme of the market and how well the market moves. Like that is a crazy, like that thing just moving on the on the chart. And I'm not gonna lie, I never used the second time frame. That is a crazy concept to even think about. But you can go as low as 1 second if you really, really wanted to. I just preferably like to see it. The minute is really cool. It's, you know, you can get a really good entry if you know what you're looking for. Anything less than that, I think, is just a little absurd. But hey, everybody has their own strategies, and that's the great thing about investing. It's not a one-trick pony. It's not a get-rich-quick scheme. It's not something that, you know, it's not a copy and paste kind of market or career. It's something that you can create your own. It's just like being a basketball player. You know, you got Steph, who is a three-point shooter. He can dribble a little bit. Then you got Chris Paul, who's also a point guard, but he dribbles better than Steph. He's not an aggressive shooter like Steph is, but he's really good at getting assists and getting the ball out of his hands into somebody that can score the ball. Then you got somebody like LeBron, who's an all-around player. You have so many unique dynamics of the way you can approach basketball. Is the same thing with trading. You can have so many unique dynamics with investing and trading that you can have an approach any kind of way, and it can be successful for you. Now, it might not work for somebody else, but that's just simply because what works for you might not work for them. So you have to understand that there's not just a copy and paste strategy that works for everybody. Everybody's strategy is different. Everybody's approach is different. Everybody's execution is different. So once you understand that, you can release yourself from losing trades and turn into a winning, profitable trader if you apply the right strategy to you. All right, I'm done. If you guys want more tips and tricks about day trading and investing, make sure to click the link in the bio, www.continuebelief.com. I share a lot of free resources and tools, tips and tricks about how to day trade, how to get started investing, and so much more. So make sure you guys check out the link in the bio. Thank you guys so much. And this helps me actually go into my next topic, the difference between volatility and the difference between risk. Volatility is the activity of the stock that's moving. So a volatile stock is where a stock is moving very aggressively up and down, very quickly, very active, stock. Compared to risk is simply money that you're willing to lose. So risking something, or, willing to give up or lose, essentially. So risk is essentially that, what you're willing to give up or lose. So a lot of people get this confused sometimes because they think volatility is risk and risk is volatility, but that's not the case. They're two separate things and they have two separate ways of indicating. So if you're a day trader and you're looking at taking a day trade, you're going to want to acknowledge what your risk is, and you want to acknowledge how volatile the stock that you're trading is, just so you can get a gauge and an idea of how well or how much this stock is moving, right? So if there's a volatile stock, you're probably going to want to trade it if you know what you're doing and you have an idea of what you're risking in order for you to make good money, because every risk comes with some form of reward. So yes, you might be risking something. It's just like going to the casino to gamble. you know you're going to the casino with $1,000. That means that in the event you lose all that money, you're willing to risk up to $1,000 in the casino. However, your reward could be $500. So you could be risking 1,000 to make 500, or you could be risking 1,000 to make 1,000, or risking 1,000 to try to make 2,000. Who knows? It just depends upon what you're capable and willing to let go, essentially. So just like that, same way applies to trading. You know, you're going into the market with a set amount of money that you have in your account, and from that amount of money, you're willing to put this amount of money into each trade. From that amount of money that you're putting into each trade, you're now willing to risk up to, let's say, 20% of that amount. So 20% hits, okay, that's my risk, I'm out of it, boom, you lost. But you protected your capital because you have a risk in place, which means you have a stop loss in place. Now, that same trade could have went right for you and you would have made whatever your target price was. So if you hit your target, essentially you'd want the target to be greater than your risk. In other words, you want your reward to be greater than your risk, because if you're risking something, you're going to want a return greater than what you're risking. I'm dropping gems, y'all. I want y'all to, I hope you guys are listening so much. Open your ears and pay attention. You want to be risking less than what you're trying to make every time you go into any kind of investing, whether you're investing in stocks, investing to a business, investing to yourself, going to the casino, whatever it is you do. You always want to make sure your reward is always going to be greater than your risk. That's how you take quality setups and quality trades. So that's the difference between volatility and risk. Should you buy gold? Given its current movement, as of today, right now, the market's open as of right now. I checked before the video, and the market with gold, I think, is sitting somewhere around 4,900. All-time highs were somewhere around 5,600. I think it's still not a bad price to buy at. However, I do and would like to see it pull back a little bit lower. My personal price targets, is that if we can get around $4,077.31, that would be an absolute buy in my opinion. And then if we can pull back even closer to 4,200, if we're not able to get lower than that, I think that's still a good buy as well. So yes, I do think that gold is worth buying. Even if you buy it at these current prices, they're not bad prices to buy it at all. I would just say leave some money to the side. So if and when the market does pull back lower, or gold does pull back lower, you have the ability to buy more. So those are my thoughts. Let me know you guys' thoughts in the comments. Have you guys bought gold? If so, are you still holding? Have you sold it? You know, gold is an essential resource. It's a natural resource. So it'll always have its form of value, especially if the market and the monetary dollars that we know, like, and love and use on a day-to-day basis go away. You know, in the event that happens, people are just going to barter and trade using natural resources like gold or oil or silver or anything. Now, silver is a different story. You know, silver is made, I didn't know this, I just learned this recently, that silver is made from all the other natural metals. So like copper, gold, and all these other metals, they are extracted from those metals and then they're turned into what we now know as silver. So silver, I think, is still essential as well, but I definitely think that gold trumps all natural resources when it comes to the overall most valuable metal. So gold is definitely something that you guys should keep an eye on, regardless of where the market has it going, even if it's volatile or not, because gold has had very slow years at periods of time, and gold has now had a very run-up year where it ran up really, really well. So you just want to be mindful of gold, even because it's a quiet mover. It's something that moves in the background without you really paying attention to it. So keep an eye out for gold no matter what. Which tech dip should you buy? In my opinion, you want to buy the tech dips that have the most opportunity to grow in the future. And that's a very vague answer. It can be considered a very vague answer, but it's also an answer that if you just look at the companies that we have presented in front of us, you can dictate and know which companies are doing well just by the current performance and what they're currently planning and putting into motion, like Nvidia, like Meta, like Tesla, and all these other companies, you know what I mean? So you want to be mindful of what these current companies that are leaders in these spaces are doing, and pay attention to what their plans are going forward. Because if you just look into what the company's plans are and how they're planning and how they're delivering the plan, then you'll know which ones are worth buying, right? So in particular, at least for me, in tangent to that, my personal companies that I'm watching to buy that have currently seen or already have seen some form of drawdown as of right now are Netflix, Microsoft, Google, Amazon, and I believe that's it at the moment. So some of the Mag 7 names, we've seen some drawdown and some pullback come back in from these markets, from these particular names after their earnings reports. And so I think that if they do come down a little bit lower, I would love to buy these companies. You want to buy great companies that come down less than 20%. And then if they reach even lower than 20%, you want to definitely load the boat on these companies. Like even if it gets close to 40 to 50%, then you should consider, finding a way to pull money from your grandma's fund, your underneath your bed, wherever you can find $1, you need to pull that money out and put it in the market and buy a company that's well under its value, especially half off. If you see a company like Meta half off of the price, you want to buy that company with everything that you have and hold for the long term. There's no reason why you would be afraid of risking something that you use you wouldn't be afraid. There's no reason why you would be afraid of risking money on something that you use every single day. I'm gonna let that sit. All right, so food for thought. Anytime a company comes down less than 20%, more than 20%, good time to buy. Even more than 20%, 30%, 40%, 50%, 60%, oh, y'all, load the boat. Especially on companies that are doing well and companies that aren't affected by AI and can lead and can be empowered by AI in the future. All right, so just keep that in mind going into 2026 and just going forward, even past 2026, wherever you're watching this, whenever you're watching this, make sure to keep those things in mind, okay? But yes, those are my companies that I'm watching for tech. If they continue to dip, I will be looking to take positions on those. I don't have target prices on those companies, but I will probably make a short video just to kind of give you guys an idea or guesstimate of where I think these prices would be good to buy at, and make some receipts for it. I want to stamp the things that I say and make sure I can look back on it one day and say, oh yeah, I said that this would come to this price, and I said it would go back up after going to this price. So it's all about recognition and keeping receipts. Gotta keep the receipts because people gonna not believe it. Like I'm starting these videos in 2026 and doing these podcasts in 2026. In the future, people can look back on these podcasts and see the archives or just see the different things I've said in these videos and learn from them to that day, because they're gonna be such timeless videos. They're gonna be videos that will always teach and give game and educate people no matter what. So I'm very, very grateful that I have that ability to be forward thinking and be a visionary in what I see life being, not only for me, but for others as well. And just helping other people change their lives step by step, because I know that that's what I'm doing each and every day. We were in LA for the weekend, and, I was out there for one of my other businesses where I sell shoes, and it was a really good turnout weekend. We had a really good time picking up pairs. It was crazy. People was breaking out fights, and it was a lot going on, but it showed me how blessed I am to have God with me. Because even in the midst of missing my flight and the chaos of standing in the lines and dealing with all the different energies and people coming from all these different backgrounds, I knew I was protected and blessed and covered with God, because I was calm. I wasn't anxious. I wasn't fearful. I wasn't any of these things. And so a lot of people don't have that ability to be at peace with any situation or any obstacle that rises. So if you're one of those people, just breathe, learn to relax, learn to talk to God and really build a relationship with God and trust him with your whole heart that he has your back and he has you protected no matter what. I can say wholeheartedly to myself that I know God's got my back regardless of anything, because I've been near death experiences and faced those things, but I've overcame them each time and time again, and it just showed me and reinstilled my belief and my faith in his purpose for me and what he believes for me to be true. So hopefully that gives some form of value or food for thought for people. And yeah, with that being said, y'all, we finally did it. It was Ep. 15 of the Rich Off Games podcast. It's your boy CB checking in with you guys. I hope y'all enjoyed. I will see y'all next Monday on time. It will be back on track next Monday. See you guys then. Stay safe, stay blessed. Peace.